Mortgage rates hit their lowest point since February of 2023, but in a shocking twist, they shot up right after Fed's latest announcement. What's happening? And more importantly, should you lock in your rate now or wait for something better? Today, we are going to break down the market's roller coaster ride, what it means for you, and where rates might be headed next. Rates shooting up after the Fed announcement was a classic case of buy the rumor, sell the news. For those who closely follow the markets, this makes total sense. Investors had already priced in their expectations before the official announcement, so it once came in, there was a wave of profit taking. But for the vast majority who just follow the headlines, this seems counterintuitive. Many expected the rates to drop immediately after the Fed spoke, but the market had other plans. Now, before we get into what might happen next, you might be asking yourself, if I'm looking to refinance, should I lock in now or should I wait? Let's break it down because there's a lot happening now that's impacting mortgage rates. First, let's talk about the housing market. We are seeing a rapid drop in housing sales, especially after the weaker than expected summer. As we head into the latest quarter of the year, we are also entering a seasonally weaker period for home sales. Could this push mortgage rates even lower? It's certainly possible, especially if demand keeps softening. And here's another important factor to consider. Many are anticipating another Fed rate cut in November. If that happens, we could see more downward pressure on mortgage rates, making refinancing an attractive option for many. Now, let's take a look at the economic data we got last week. Core CPI inflation. This is a key inflation measure the Fed watches closely. Last month, it rose to just 0.1% compared to the forecast of 0.2%. This suggests inflation is cooling off a bit, which is generally good for rates. Annual core PCE, the year-over-year figure came in at 2.7%, matching expectations. It was slightly higher than the last month's 2.6%, so inflation seems steady, not soaring, but also not dropping dramatically. Consumer sentiment. This metric tells us how confident people feel about the economy, came in higher than expected at 70.1. Higher consumer confidence can mean more spending, which could affect mortgage rates. However, there's always a caveat. This week is packed with new economic data releases, everything from employment numbers to consumer spending reports, and any surprises in this data could cause some temporary volatility in rates either up or down. If the data shows unexpected strength, rates might spike temporarily. But if things go as expected, we might see a decline in rates. So the key is timing if you are considering financing. Rates seem to be trending downwards, but upcoming economic data could bring surprises. Make sure you are staying tuned. I'll guide you through each market move. Make sure to hit subscribe, like, and hit that notification bell so you don't miss out on any updates. I'll be closely following all the trends to help you make the best decision on your mortgage journey.